And thanks, everybody, for joining us today. This webcast is entitled Try to Remember, which was a tremendous song from the musical The Fantastics, sung by Jerry Orbach, who's on one of those crime shows later in his career. The Fantastics ran for 42 years off Broadway, making it the longest-running musical in world history. And one of the reasons that was possible was it's very cheap to put it on. The set was very minimal and didn't cost much to produce. So what I'm talking about here with Try to Remember is I came up with this title when I was thinking about how it was 5 years ago that we went into COVID and really went to the lockdowns a few months later, and try to remember just how different the world was pre-COVID and how different the world is today versus those lockdown periods. And I'm going to put into the context some of the things that are affecting the markets and the Fed and the potential economic cycle through the course of this webcast, trying to keep this at quite a high level today. Here is the history of Fed funds implied by the shape of the yield curve or the warp function. And we have all these various dates on here, which are FOMC meetings. So it's interesting that at January, the blue line, almost a year ago, a little less than 11 months ago, we see that the Fed was expected to be dropping rates down by the end of 2025 to 3.33. And then we see that we had the June FOMC meeting where it had changed higher by about 75 basis points or so. And just 3 short months later, the red line, September, there was a reassessment. So we've had a very significant change over the course of 2024 in what people were forecasting the Fed was going to do by the end of 2025. The time period that has not exhibited much of a shift is since the November 7th meeting, 2 days after the election, where we see that it's 378 as of the November meeting, and today, on yesterday's bond market pricing anyway, 3.71. So this has been the period of the most minimal change, and we've had very big swings as the inflation data has meandered during 2024. One thing that Jay Powell has been talking about in his most recent press conferences is that the labor market is largely back into a balance in terms of supply and demand. And this is kind of the proof statement of that. We see the orange line is job openings, and we see the blue line is the labor force. And we're almost in exactly the same position as we were the 3 years before the COVID lockdown. So he's right when he says we've had a lot of volatility, but we're sort of back in balance. So we're not really looking we're not so worried about the inflationary consequences as we were. Here is a long-term history of the Fed funds rate and the 2-year Treasury. And I've been saying this for years. I say it virtually every webcast. The Fed follows the 2-year Treasury. And this slide clearly is a proof statement of that. In fact, if we look at the most recent 20 years or so, it's quite clear that the goldish line, the tan line, which is the 2-year yield, has been leading the Fed policy rate, which is the blue line, which moves in step functions because they meet on a periodic basis, and they haven't very often done intermeeting changes to the Fed funds rate. So let's just start with back in 2004. It's quite obvious that the 2-year Treasury led the Fed policy on the way up in 2006 and 7. It's quite obvious that the 2-year Treasury led the Fed going into the global financial crisis. They kept rates virtually at zero for a number of years, almost 8 years. And you'll notice that the tan gold line, the 2-year Treasury yield, very obviously led the Fed higher going into the middle part of the tens. And then we see, again, it led the Fed going into the rate decline from 2019. And again, in 2021, we see that it led the Fed on the way up. We thought that the Fed was quite far behind the curve going into 2022. And indeed, 2022 created the worst bear market in bonds of all time because the Fed was so far behind the curve. And now we see with this easing cycle, once again, the 2-year Treasury was very significantly leading the Fed. In fact, we got one of the biggest gaps ever between the 2-year Treasury yield and the Fed funds rate, which was hanging out at about 5 3/8 or so. And the 2-year Treasury was saying, wait a minute, guys, you're probably too tight by about 100 basis points. So the Fed has corrected about 75 basis points of that gap, but there still seems to be a ways for the Fed to cut rates again. and we would expect the odds to be greater than 50% that the Fed will cut rates at their upcoming FOMC meeting next week. So they'll get down more in line with the 2-year Treasury, which is what Fed Chair Jay Powell, I believe, means when he says that we're recalibrating the Fed funds rate. That's code word for we're following the 2-year Treasury closely. Here is the CPI going back to 1984, so going back 40 years, the headline and the core CPI levels, and we'll notice that it was going up in almost a linear fashion. So it was almost baked into the psyche of the market that the CPI was going to keep going up at about that constant pace, which since 1983 was 2.8% annualized for the headline and 2.9 annualized for the core. And then all of a sudden, we see try to remember, the lockdowns and all of a sudden the money printing that happened, and we have a totally different trajectory on the CPI, and it really hasn't yet flattened out. It's still rising at a greater pace than what we had prior to the lockdowns. And obviously, this is what's bothering people. The fact that the CPI is now likely to settle in the mid 2% type of annualized rate of change basis, that sounds good if you listen to the politicians, because it's a lot lower than the 9% inflation rate that we had at the very highs in the CPI year over year. But people are still experiencing these very high price levels. And the cumulative inflation since 2020 is 5% annualized, more than double the Fed's target. And so it will take some time of subdued inflation to get this back to the longer-term trend of around even the high 2% sort of level. Here, I'm not going to talk a lot about inflation indices. We had a deep dive into that a couple webcasts ago. Almost the whole webcast was dedicated to it, and it's up on replay. But here we see this has been the volatility in the CPI for decades, really about 30 years. We see with variation, the CPI headline and core were around 2.5%. And that became a paradigm that investors were used to, and that got shattered with all of the COVID and money printing. And now we've settled back close to that level. So inflation can be stable for a long period of time, but that doesn't mean it will remain stable forever. And we've certainly seen a lot of volatility in the past 4 years. And of course, the money printing looks a lot. Let's go back 2 slides. See how the CPI started to go more vertical in the aftermath of the lockdowns? Well, that has everything to do with the money supply. The M2 money supply was exploded with all of that money printing, over $7 trillion of money printing, and we're still way above the trend in M2 that we were for the 20 years or so prior to the lockdown, although M2 is now growing again. This is directly responsible for this inflation. As Milton Friedman famously said, inflation is always and forever a monetary phenomenon of too much money being printed relative to the output of goods. So if we go back and look at CPI over long-term time periods, we see that for 30 years, the headline CPI and the core CPI are right around 2.5%. And we have PCE on the right-hand panel, and it's a little bit lower. We don't have the 30-year for the PCE, we have the 20-year, and that's in the low 2s, which is the Fed's target. We look at the gap on the right panel, the PCE, and it's awfully big versus the dotted line trend and the acceleration we've had over the past 4 years. It's going to take a long time period of subdued inflation, meaning 2% or less than 2%, to get us back to that longer-term trend. I like import and export prices. I talk about them as the most important and legitimate inflation indices, and they are not at all alarming. We see that the import and export prices have been round zero or negative for much of the past 2 years, so getting us back toward that longer-term trend that we all became so familiar with. Now, one thing that's good about the inflation rate is at least the quits rate is falling, and we can see that the tan line is the quits rate, and the blue line is the Atlanta Fed wage growth tracker, 3-month moving average, and we've got an 8-month lead on the quits rate. It tends to lead the Atlanta Fed wage growth tracker, and it suggests that we still have some deflation or disinflation coming from wage growth. Unfortunately, we did see a quits rate pop up. We'll see if that was an aberration, but it still suggests nonetheless, with the most recent uptick, that inflation on wages is probably still under some downward pressure. That leads us to believe, in addition to energy prices, which I'll talk about a little later, that it's quite possible that we could actually get down to the low twos in terms of the CPI, depending upon how things evolve in the next few months. Sometime late in the spring of 2025, we might get down there. And I think that's what Jay Powell is hoping for, with the labor market imbalance and maybe inflation not retracing higher to the upside, at least in the coming months. Here's the Fed funds rate and the 12-month hike cut expectations, so 12 months forward, and we can still see that there's a big gap between the Fed funds rate, which is that a lighter blue line, and the 12-month hike cut expectations, where the market seems to think that the Fed over the next 12 months should cut rates by about 100 basis points. And that would get us down. We're using the high end of the Fed funds rate. It's officially 4.5 to 4 3/4, I think. So really it's about 4 5/8. And so we're still about 75 to 100 basis points of cuts are priced in. And if you look at the bottom, the shading areas show how very wide the gap was between the Fed funds rate and the expectations for the Fed funds rate. It's the highest in 20 years that this chart encapsulates. So let's talk about the economy. And these are longer term looks at some of the indicators that we check in on periodically in these webcasts. And as always, the vertical shaded sort of pink bars are the official recession periods. And the leading economic indicators, we have the year over year on here, which is the blue line, and the goldish line is the 6-month annualized, and they're virtually the same and have been nearly the same. So we've been running at a kind of a persistently weak 6-month and 12-month LEI indicator for quite some time. Historically, if we look back and try to remember historically how these things have worked, is that this type of dynamic has been highly coincident and predictive of recession. Once the LEI gets into this kind of negative level of this magnitude and then starts reverting higher, but this time no official recession has happened. This is the contributors to LEI. These are the underlying data inputs. And it's fascinating that the only ones that are positive are stock prices, which are the biggest gainer in the LEI contributors, and credit, which has done very, very well. Spreads across the credit spectrum have tightened quite a lot over the past 14 months or so. Manufacturers' new orders have flipped slightly positive, but we see building permits, expectations, claims, unemployment claims, interest rate spread, which is the yield curve being the way it is, and then weekly hours are negative, and ISM new orders are really negative, leading to this accumulation of a significantly negative LEI, but no recession yet. This is another very good historical recession indicator, and it is the comparison of consumer confidence expectations minus the present situation. So the present situation is the tan line, and it's been fading. Meanwhile, the expectations of the future have been negative for about 4 years or so, although they're less negative now. The deterioration in the present situation, accompanied with the small increase in expectations, leads to that red shaded area at the bottom shrinking. And if you go back during the last 4 recessions, and we can maybe discount COVID because it's so unusual, but in all those cases, we see that it's once the expectations starts to get less negative, when the red shaded area starts to shrink, it tends to mean that you're on the doorstep of recession. And that has been happening here, although still no recession. So we're on watch based upon our memories of the past that these things are definitely showing at least yellow warning signals, but still we have nominal GDP and real GDP not showing recessionary tendencies at this time. Here's the yield curve steepening before recessions, and here we go back 45 years, and we see that once the yield curve inverts, it tends to be getting late in the economic cycle, but then once it starts to get less inverted, which has been happening now, it tends to be a foreshadow of recession. Really, you need the yield curve to go fully positive. This is the 2s-10 spread, And we're positive, but we don't have really the 12-month moving average going up to that de-inverted situation. That will happen if we continue to move on through time in the next several months, but it hasn't happened yet. So something to watch out for is that 12-month moving average of the 2-10s yield curve. Here is what's our DoubleLine's version of that SOM rule, where they talk about how when you get a certain movement in the unemployment rate, then you should be watching out for recession. We just oversimplify it perhaps, but we just take the unemployment rate and we compare it to its 3-year moving average. It's a monthly series, so 36 data points is 3 years. And once the blue line crosses over its 36-month moving average, boy, it sure has been the gateway to a recession. That hasn't happened yet. So we're in a different world than we remember, and we're going to talk about maybe why that is in just a little while. Here is the federal interest expense as a percentage of federal revenue. It was quite high back in 1990. Rates were a lot higher then. We had a very high coupon on average in the Treasury market in the aftermath of the late 70s and through the 80s into the early 90s. Now it's basically just because the debt's so big. And we have the CBO's forecast on what interest expense as a percentage of federal revenue will be in the coming years. And I noticed that it hooks down and then reverts back up. That's because they assume expiration of Trump's tax cuts, which is probably not going to happen at this point. But that's why we have that little kink in the dotted blue line. But look at the trajectory of this thing. We were down at about 7.5% of interest expense as a percentage of federal revenue. And now we're already at double that at 15%. And the CBO, which is not a conservative forecast, it tends to be an optimistic forecast for reasons I've spoken to in the past, but it shows that it's going to go up another 7.5% or so in just the decade ahead. I'm quite certain that that's an optimistic forecast, and that unless interest rates are collapsed lower again, we are going to be rolling off of low interest Treasury debt, replacing it with high interest debt. And this is the fundamental problem of our times. I'm encouraged that Elon Musk and Vivek Ramaswamy have started this idea of let's try to eliminate some of the waste in the government. We certainly know there's a lot of waste in the government. So I'm hopeful that the Department of Government Efficiency will have some real teeth to it and start to address this problem in real time, because I've spoken many times we need to. This is another context of where we are in our fiscal situation. We have the budget balance and economic expansion. So we start out, all the different colored lines, it starts out with the official beginning of an expansion. And the black line is where we are now. So you'll notice that we've been in an expansion here for all these months, and yet we have the worst budget balance of any of the past recessions going back to the 1950s. So if you think that you can map the past into today, well, just try to remember that we are starting off in a much worse position than any other late cycle expansion, making the work of the government efficiency department makes it even more critical to the mission. And of course, I like to point out that once you go into recessions, the red shaded areas, the blue line, which is the unemployment rate, tends to go up. It's already going up, and we're not even in recession. And then the federal budget balance tends to get worse for obvious reasons during recessions. Taxes are down, outlays go up due to unemployment benefits and the like. And we're already starting out with the tan area at 6.23. That's the official, most recently stated deficit as a percent of GDP. It's understated. The federal deficit is about $160 billion higher than what they officially report for various technical reasons. Some things they've deemed to be temporary, but they seem to be structurally embedded. So right now, if you actually take the last 12 months of GDP and compare it to the last 12 months of deficit spending, we're actually at 7.5%. This is the unofficial number, but it's the true number. 7.5% of GDP is already a budget deficit. Of course, during recessions, it goes up by multiple percentage points. So we need that Doge group to get to work the day before yesterday. Now, here is something interesting, and this is the long-term trend in 30-year bond yields. And we would say the same for most bond yields. I'm just using the 30-year here. And we say that going back to 1990, we were in a channel fairly broad channel, but it was contained by this channel, and it was secularly declining interest rates. And we have been above that channel, the top red line, for quite a while now, going back a couple of years, and we've hardly made any progress at all in terms of retracing. Somebody asked me a question. They said they bought some bond funds in August of 2021 and they're underwater. Well, of course you're underwater because you've seen rates go from about 1.5%, I'm just using the 30-year here, up by about 300 basis points or so, maybe even 350 basis points, which means that the 30-year Treasury bond has had a drawdown in price from the high price back in 2021 to the price today of almost 50%. So if you have long-term bonds, you have sustained and continue to sustain very significant losses. Thankfully, we're not losing this year. This is the look of the bond market, the Treasury bond market this year. And we've got various points on the yield curve. We've got the 1-month performance where we see everything's up. And basically the best performer for the last month is the 30-year Treasury bond, which is a little bit better than, say, the 7 and 10-year Treasury bond. But then we see year to date a totally different picture. We see that only shorter-term bonds have performed well this year. We see that year to date you've made money on 2-year Treasuries, less than money market funds, unfortunately, but you've made money on 2-year Treasuries. And as you go further out the yield curve, it gets less and less and less, and then you go negative once you get 20 years and out. We at DoubleLine have been expecting this sort of a trend. It's one of the reasons why we have some significant outperformance here in 2024 is we've been positioned advantageously relative to the yield curve. Here's something interesting. We're looking at the Fed cutting cycle since 1984. And basically we have the mean, which is the yellow line, and we've got a gray line, which is the median, and they're almost the same line. It basically means that once the Fed starts the initial cut, that's that vertical line in the middle of the exhibit, generally you get gains on the 10-year Treasury. In other words, the performance of the 10-year Treasury is positive, and it has remained positive generally for almost a year after the Fed's initial cut. Not this time. This time, the red line, we've actually seen negative performance on the 10-year. So what's happening here is as the Fed cuts interest rates, perhaps because they feel comfortable about inflation and are worried about the rising unemployment rate, we are not getting gains from long-term Treasury bonds. We're actually getting moderate losses. And I think this is a new theme. I've been saying that when you live in a secularly declining interest rate environment, you draw conclusions from them. You remember things, but maybe those things are not worth remembering. Maybe you shouldn't try to remember them because when you go into a different secular environment, maybe things start to act very differently. Certainly, this is not a high data sample here. We're only looking at this one interest rate cutting cycle, but it is very different. It's the worst one in terms of the 10-year Treasury performance after the initial rate cut, going back 40 years. And here's another look at it. This is performance in the 10-year after the Fed starts cutting rates. And we're just showing the same type of a setup where the green line is now worse than than all of them, going back to these many rate cutting cycles. So let's look at the bloodless verdict of the market so far nearing the end of 2024. This goes through the end of November. We see obviously that stocks have done very well, and it's kind of across the board in the U.S. anyway. The S&P 500 and the NASDAQ virtually the same. Russell 2000 has been playing catch up a little bit, but still lagging in line with the Dow Jones, but not the ones with all the momentum in them. And then we see that other markets positive, but nowhere near as much. And we go to the bond market, and there's not a lot of return in the high quality area. We've got the return is in CMBS, which was our favorite asset class, one of them throughout 2024 and continues to be. And then we see lower quality sectors, high yield bonds up about 8.7, bank loans about the same. In spite of the fact that the Fed has started cutting rates, bank loans have held up, although the SOFR rate against which they're priced has been in decline. So you're losing a little bit of coupon on bank loans, but so far only 75 basis points of cuts. Now we see EM sovereign doing quite well. The dollar has gone up this year by 4.3% versus a basket, which is dominated by the euro, and all these other currencies are negative. So you've been better off in the dollar than in foreign currencies. And we see commodities, it's basically gold. Gold is up, silver is too, we don't have it on the exhibit, but up 28% year to date. And of course, Bitcoin is like gold on a lot of leverage, so it's up a lot. We don't have it on the exhibit. Then we see the agricultural commodities, oil's down, both Brent and WTI. So pretty much the commodity index, the Bloomberg Commodity Index, is only up 4% year to date, sort of in line with a money market fund. Here are a history of Bloomberg Aggregate Index drawdowns going back a long time to 1980, actually the late 70s. And we see this is a pretty big drawdown, the biggest drawdown going back all these years. The worst one before was in the late 70s, early 80s, under the Carter regime. And then we see under the Biden regime, which I always said was going to be an echo of the Carter regime, we see the worst drawdown ever, even significantly worse than the late 70s. So it looks like the drawdown may have reached its nadir, 17.2, because we're quite far below the high yields of the cycle, which were registered in October of 2023 when the 10-year Treasury got to 5%, and now it's at about living life at about 4.25%, so 75 basis points off its highs. Here's S&P returns by year, and we've got these boxes drawn in black, and it sort of shows that this has been an awfully good 2 years, basically 27% for 2 years in a row, kind of similar to 82, 83 maybe. But it doesn't mean it has to be the end of the line. We see that in many instances of these big years, sometimes you go further. Certainly that was the case in the late 90s, where we had a 38 and a 23 and then a 33. My gosh, that was quite the market bubble. That doesn't mean it could possibly be repeated, but from these PE levels, it seems hard for me to believe this late in the economic cycles that we're going to see 25% per annum for the next 3 years. But this just shows that there are streaks they're very significant of high performance, and there's streaks also of negative performance. One thing that has really gotten on steroids most recently here in 2024 is U.S. equity outperformance versus the rest of the world. Here we go back 30 years, and we see that there was a period where there was very similar performance, broadly speaking, between the U.S. and the rest of the world from 1999 or so until around 2019 or so, with some variation in between, but point to point about the same. And ever since starting in the early 2010s, it's been almost a one-way trip for the U.S. equity performance versus the rest of the world. Now, if we go back even further in time, going back 74 years, what we see is that we're totally out of the context of the past. In the past, when we got to about a Nifty 50 bubble of about 1.6 times on the scale on the y-axis, and the internet bubble, which wasn't even quite as big of a bubble, but this one is totally off the charts. It's more than double the outperformance of those past runs into what was perceived at that time to be bubble territory. So that doesn't mean that it has to stop, but I will point out that when things get this overextended, it's probably a very poor idea to be putting on the trade that has this extended and off-the-charts momentum. What I call trade locations would seem to be fairly poor on this concept. Of course, this is driven a lot by the largest 7 market cap stocks in the S&P 500, where it's gone from 15% of the S&P 500's weight in the top 7 stocks back 10 years ago to now 32%, so virtually double. So we have a highly concentrated market, highly concentrated in geographically the United States, and highly concentrated within that U.S. market. Here is the S&P 500 cap weighted, which is what we is quoted every day in financial media, versus the equal weighted. And we have a double top, it would appear. Going back to 2009, we got to almost exactly the same level, and it remains elevated, but perhaps it has begun to reverse. I certainly would greatly favor an equal weighted stock investment in the S&P 500 to a momentum-based cap weighted, since this seems to have run into very rarefied territory. Same is true, and not coincidentally, of large cap versus small cap, because large cap stocks have been obviously the ones that are leading the market cap. And so we see that the S&P 500 has also kind of double topped versus the Russell 2000 going back to the late 90s. And perhaps also, like equal versus cap weighted, has begun to reverse. Whether that's true or not, nobody knows. But again, trade location would augur in favor of fading this sort of extreme momentum move if you philosophically think about things the way that I do. One thing that's fascinating, I bring this up because here we have all these long extended outperformances. One of the things that was a long extended outperformance for a few years that ended a couple of years ago was this ESG green stock stuff. And if everybody wanted to get into green stocks and green stock overweights, well, that's been a disaster versus owning just a basket of the S&P 500. So the S&P Global Clean Energy total return is negative 39% going back to the end of 2022. And the S&P 500 is plus 59%. So if you pile into these momentum trades, this is the type of risk that you are piling into. So try to remember that these things do not go on forever. Taking a quick look, this is the commodity index. And we see the Bloomberg Commodity Index, after a very significant rise thanks to the Fed's money printing in the aftermath of COVID, where the commodity index more than doubled, it has now settled back in at what looks to be something of a support level, although it is below the 200-day moving average. We are sort of on a shelf for commodity prices. As we'll see in a moment, that's also true for crude oil, a very important commodity. Here's gold, which we've been positive on for quite some time now, and it has kind of stalled out for the time being, but it had a huge breakout above that 2,000 level. And the measured move, as the technicians call it, is that however long the horizontal is before the breakout, so from 2000 to 2023, sometimes the move has that same distance to the vertical side after the breakout. That would sort of suggest that gold could probably make it up to 3,000 on this move. Copper gold ratio, we used this for years, and I remember it working very, very well. But ever since rates bottomed out, the copper gold ratio has completely not worked. It's completely not worked. We see since rates started rising in 2022, we see the copper gold ratio, which is the goldish line, suggests that the 10-year Treasury should be much, much lower in yield, down at around 1.5%. But instead, it's up at 4.2%. I believe that the copper gold ratio is probably not going to work going forward if we're in secularly rising interest rates, which is my base case. So it seems to have worked for the reasons of disinflation and deflation during the secular decline in interest rates. And now gold is being bought, I think, as more of a permanent portfolio allocation and as a way of diversifying away from the fiscal woes that we are facing, that I've so repeatedly, maybe some would even say ad nauseum, been talking about. What has been working since rates started rising is simply the price of crude oil. So we're going to be focusing more carefully on this. The green line is the West Texas Intermediate crude, and we're on quite a shelf here, aren't we, at 68? It looks like we've bounced off of 68 a number of times over the past 3 years, and really being contained up in the 90s or so, except for the extreme inflation of 2021, 2022. But if this breaks down, it would suggest that rates could fall. There is a big gap right now relative to recent history. It suggests that the 10-year Treasury rate is too high using this one variable. Oil is obviously very important, but with throughout the economy, Donald Trump ran on drill, drill, drill. And so we'll see if that creates more supply, and we'll see if that creates the impetus for the blue line to break below that shelf that's spun on. If it does break below that shelf, it's probably going to go a lot lower in price. So that's something to watch out for. Watch that 67, 68 zone on West Texas Intermediate. So I talked about credit spreads being tight. This goes back 20 years. And if we look at the goldish line, that's the aggregate corporate index in the Bloomberg aggregate index. This is all investment grade. We're basically at the tightest spread going back 20 years. And the high yield index, using the Bloomberg Corporate High Yield Index, is also at a very low level, kind of matching its all-time lows. This, to me, is not really a strong sell signal, however. This, I think, ties into the fact that the corporate balance sheets, in particularly investment-grade corporations, but to a not insignificant extent also in non-investment grade borrowers, they have been well managed, and their balance sheets are in good shape. And I actually believe corporate spreads should hit an all-time tight if the health of corporate America is and has been on the mend, which is true, while the health of the Treasury Department and the government is deteriorating at a monotonic, maybe strictly monotonic rate. So there have been time periods where corporate bonds have, in certain cases, yielded the same or even less than Treasury bonds. Going back to the early 80s, IBM yielded less than the same maturity Treasury bond for a period of time because people were getting increasingly worried about the management of the Treasury debt. I think the management of the Treasury debt at the present moment is inferior to the management of corporate debt. So we'll see if there will be any impetus for these tight spread levels to expand to a more normal level. At the present time, that is not happening. Interestingly, though, if we go all the way back to 1980, if you bought a corporate index fund of corporate bonds, which tend to be about 7 to 10 year maturity bonds, typically you've gotten a pickup over Treasury bills. In fact, all the while back to 1980. Not anymore. Right now, your pickup on corporate bonds is almost non-existent. Corporate bonds yield about 5%, and T-bills yield about 4.4. So you've got all of the 60 basis point pickup. You might be better off in corporate bonds than T-bills if the Fed slashes interest rates significantly, although that probably would be a recessionary environment. So one has to think the cross currents of credit during what would have to be a significant economic slowdown to get those T-bill rates down to levels that we saw, during the global financial crisis aftermath. This is interesting. This is a measure of risk sentiment as exhibited by the corporate bond market. We compare the highest rating of the junk market, BB, to the weakest rating of the junk market, CCC. And so when that blue line is elevated, it means people are concerned. They're requiring a lot of excess yield to go down in credit in junk from the best credit in the junk universe to the lowest credit. Notice how that blue line has utterly collapsed here in 2024. It suggests that there is great degree of risk-taking sentiment in the corporate bond market. I don't know if it's egregious or not at this level. We're not at the tightest levels. There could be some room for this to go down, but we are certainly have come in an awful lot from where we were in just 2 years ago, where there was a 900 basis point spread, BB to CCC, and now it's less than half of that. So risk manage accordingly. Default rates have settled down a little bit in the high yield bond market. We see, I use the ones on the right-hand side of the exhibit that include distressed exchanges. That's a better look at defaults. What we see is high yield bonds are very low, still at 1.4. They've actually come down. Loans are on the rise, which is not surprising. These loans are, we talked about this, that defaults would go up in the loan market because they have a direct tie-in to the Fed funds rate, and the Fed funds rate went up by 500 basis points. And so these companies have had a stress on their interest expense, and that's been exhibited in real time. So we're seeing this divergence. One thing that happened in 2024 is the JP Morgan Emerging Market Bond Index reintroduced Venezuela. So we have the red line, which is the emerging market spread to Treasuries, excluding Venezuela. Then we see the blue line, which started to include Venezuela into the index back in the earlier part of this year. So what it ended up doing is adding about 50 basis points. Just adding Venezuela adds 50 basis points to the emerging market spread versus Treasuries. But you have to own Venezuela to get that spread, something that is only for those that are significant risk takers, I would suggest. So the actual yield on apples to apples comparison, where we exclude Venezuela, we've seen a huge spread tightening on the emerging market index, excluding Venezuela, where it's gone from nearly 600 basis points just 2 years ago down to less than half of that. So all in lockstep, the high yield bond market, the emerging markets in lockstep in terms of their spread tightening. Here is one of the most fascinating charts. And it's, again, just don't try to remember that what you think you know is based upon a secular economic or a market set that may no longer be in play. Who'd have thought that we would have Chinese bonds yielding less than Japanese bonds after all those years of yield suppression in Japan? But it's happened. The Japanese bonds yield 2.27 on the 30-year, and Chinese bonds only 2.12, which is highly suggestive of more stress in the Chinese economy, I believe, than the official government statistics are willing to report. So this is an interesting development that Japan is now a high yielder versus China. Just a fun fact to know and tell. So a lot of questions as always, and also, per usual, a lot of them revolve around the same themes. One question is there a level of the Fed balance sheet that you would start to feel more comfortable once achieved? Well, the level that I'd like to see achieved is 0 on the Fed's balance sheet. But certainly, I'd like to continue to see the balance sheet shrink. Jay Powell, in a recent press conference, kind of went off script, I think, and let it slip that he wants to get the balance sheet down because they want to be able to gun it back up again as a tool. He wasn't quite that forthright about it, but that's how I interpreted his words. So it looks like balance sheet manipulation is going to be an ongoing tool in the Fed's toolkit. Questions on gold. What will be the next driver? The driver for the next leg of performance in gold, I would just say it's mistrust in institutions. A trend that I've been talking about that's been accelerating. If you don't see it, you need to open your eyes a little wider, because there's a great pushback against embedded, ossified, no longer performing institutions, and gold is a way of getting around the arbitrary nature of those things. Someone says, has your diet or nutrition changed since the news and debates regarding RFK? Thankfully, I have always been kind of an ultra-processed food avoider, and generally speaking, try to have a high level of diet and nutrition anyway. I'm not so sure I would pass the hurdle for RFK Jr. into what his strictness, but I feel very committed for my whole life, really, to understanding that you are what you eat. What factors would make you reduce or eliminate exposure to CLOs? Interesting question. What's going on in the CLO market this year is there's negative supply. There's a lot of issuance that's going on, but it's all calling the existing deals. And so there's no supply, net supply in the CLO market. So it is understandably very well bid with no supply. What would make us reduce would be higher prices, of course, although they're already up near par. The things that we own in the CLO market are extremely high quality, extremely low risk. And we've liked them because they pay a spread above SOFR, and we've had a flat and continue to have largely a flat yield curve. So if the yield curve started to make an impulsive move towards steepening, that with short rates going down, perhaps driven by the Fed, CLOs will become much less attractive. So if there were a lot more issuance coming, CLOs would probably widen out. We probably want to reduce exposure in advance of that, but there is no sign of that happening for the foreseeable future. And so with that, there's a lot of talk about the Doge group and can they actually do anything? Well, we'll see. I'm going to break from my usual Eeyore type of personality, being skeptical about everything, and hope that the Doge group can make some real progress. I know it would have to be nickels and dimes. You're not going to hit the entitlement programs on day one, obviously, which is where a lot of the big problems are. But all these crazy programs for, I think, like $6 million. Doesn't sound like a lot, but I think we had $6 million that we gave away to promote Egyptian tourism. And there's many, many weirder ones than that. And all of those should go day one. I don't know if it accumulates anything approaching $1 trillion, but I think the journey, as the Chinese philosophers used to say, the journey of 1,000 miles begins with a single step. So hopefully it's simply the beginning of a trend in the right direction. So we'll be back with the Just Markets webcast. It's just going to be about markets broadly. And so we look forward to that and the Roundtable Prime, which is coming up in the first half of January as well. So we made it. Looks like we got 3 weeks till New Year's Eve. I hope everybody enjoys the holiday season. Stay healthy. And there's a lot of colds going on around out there. I had one over Thanksgiving with everybody else that was in our Thanksgiving celebration there. So wishing everybody a very prosperous 2025. And let's hope that we can get on a winning streak for the Buffalo Bills. We can make it one more time to the Super Bowl and win one. Thanks, everybody, for your support, and goodbye for now.